Hello and welcome to the CoStar News Hotels Podcast. I am news editor Sean McCracken, joined today by Greg Friedman, Managing Principal and CEO of the ever-growing Peachtree Group. And Greg, how are you doing today?
I'm doing well, Sean. So thanks for having me on the podcast today.
So I believe you were one of the first guests we ever had on the podcast years ago when we started, and we've gotten into kind of this annual cadence. I missed you to begin the year, but I'm glad that even if it's belated, we get kind of our annual check-in on the financing environment, since you guys are such experts in that field.
Yeah, I appreciate that, the fact that I was the first guest on the podcast. But more importantly, it's although we didn't talk earlier this year, it's funny, if we had talked in January of this year versus now, just how chaotic the market has been. Because I think, as you went into the end of last year till now, there's just been so much that's happened from a geopolitical perspective that has really impacted the markets to a certain degree, on how it's impacted real estate values, impacted real estate assets, and the credit markets, both positively and negatively.
So let's just get kind of the elephant in the room out of the way to begin with, so it's not looming over the conversation. Obviously, a lot of the times when people think of financing, they think of interest rates and how that affects the overall cost of capital. All of that seems like, despite having a new chair for the Fed, more of the same policy, at least for the time being. What's kind of your read on the current state of interest rates, and kind of where do you think things are going to trend going forward?
Yeah, I think from an interest rate perspective, it's very much going back to what I was talking about before. Going back to the end of last year, beginning of this year, I expected that rates were going to probably stabilize at a much lower level than where we are right now. I expected the 10-year to be closer to 4%. It's obviously in the mid fours, which doesn't seem like a huge differential, but it is very material to how these assets are priced. Because that's, you look at how assets are valued both on the hotel side as well as across commercial real estate. The 10-year, which is viewed as the risk-free rate, there's a direct correlation to how the underlying values or the intrinsic values of these assets. But I think with what's happening both geopolitically, and there's been positive news technically on that front, but it's still, I think we're in this higher for longer long-term interest rate environment where the 10-year is going to remain elevated, which is going to keep pressure on long-term rates being higher. And I expect that at the again, beginning of this year, people expected multiple rate cuts this year. I expect that it's going to be very hard to cut rates in the near term. I mean, there's theoretically there's risks, because we still have a lot of inflation in the environment. There's risk that rates could go higher. The 10-year, even as we're doing this podcast today on July 7th, the 10-year has crossed the 4.5% mark this morning, which it could arguably go closer to 5%, and that would have a huge impact on the long term side, and it potentially could put as rates are continuing to go up, at least the bond market is expecting rates to stay higher. It could put some pressure on the Fed to increase rates as well.
So it seems like there's been kind of this attitude in recent years of kind of some investors, hoping to kind of wait out the interest rate environment, right? Like if we always have this expectation that rate cuts are looming, why not just wait a little bit till when things are better? I mean, do you think that there's a possibility that mentality kind of goes by the wayside now that people are more normalized where we're at and where we have been for a while?
I think it's started to happen. I mean, I think that's something that has happened. People have started to capitulate and realize that we are just in this environment where, long-term rates will stay higher. So I think we're at the beginning stages of that, because to your point, back in 2022, 2023, people expected that rates were going to eventually come down. And there was this expectation that, when you looked at long-term rates, short-term rates, they were going to go back to where we were pre 2022. And I just think now you have, when I say people, really owners, investors in the hotel space within commercial real estate that have come to the realization that we are just going to be in this environment for the foreseeable future. And we may never see an environment which we experienced between 2010 to 2022, where, effectively we had 0% interest rates and the 10-year, average closer to 2%, which is, obviously, that was an environment where the 10-year was half of where it is today. So, I mean, it's double, the amount. And so I think people are slowly capitulating. They're starting to realize we're in the new normal, because this is an environment that we experienced pre-great financial crisis. The 10-year was closer to this 4.5% mark. So I do think, slowly it's causing that. And that's part of the reason the transaction market has been muted. When you look at just asset sales, you're looking at, even, financing, or, new financings, were slow over the last several years. Now it's starting to pick up because, people or owners and investors of real estate are starting to realize that this is the new normal.
So, I mean, that a lot of that discussion revolves around the cost of debt. How would you describe the overall availability right now? Because that seems to be less of a problem, even if things have been a little more pricey.
Yeah, I mean, there's no question. There's a lot of capital available. I would argue that because, private credit, which was glamorized, by the media 3-4 years ago, the media made it sound very, very new, very, sexy. They really glamorized the idea of private credit. They really villainized it over the last year.
I was going to say it's kind of turned a little bit.
Yeah, it's been villainized, but that, private credit provided a huge amount of liquidity in the market, when traditional lenders had pulled back. So, we never saw a lack of credit or debt capital available for projects. It continues to be, a flood of debt capital available. But what you are seeing, and you have seen over the last couple of years, you're seeing it more importantly, even today, a bifurcation where you have, I would call it an A credit. There is, I don't want to say there's unlimited capital, but there is a lot of capital chasing, a lot of debt capital chasing to provide capital for acquisition loans, for refinances, for, A type credits. And if you're below an A credit, doesn't matter if you're a B, C, D, or E, you just fall into this next bucket where it becomes, there's less available capital for those, transitional assets. And that's where it becomes a little bit more challenging for certain ownership groups, especially, when you're dealing with this wall of debt maturities that we keep talking about, where you have across all of commercial real estate, you have close to $1 trillion of loans maturing over the next year. And, as you're seeing real time, as these loans are maturing, if an asset has, great in place cash flows, there's no challenges on them refinancing. It's when they, lack the cash flows and they haven't fully, the asset performance isn't fully recalibrated to this new interest rate environment, is where they're starting to have struggles because the asset values dropped, and they, in a lot of cases, they need to bring additional liquidity. So that's, that is a challenge.
I want to ask you about this kind of debt maturity phenomenon, because I mean, maybe I just wasn't paying a close enough attention to it before, but it does seem like it's kind of an annual discussion point now, or, it's always next year, but next year we've got this massive wave of maturities. Like, is this the new normal for or is that just always something that we kind of have to expect, like, okay, on paper, but it'll be taken care of?
Yeah, so it's I mean, the wall of maturities is it's something to be expected when you're in a very dislocated, chaotic type environment like today, where you're, continuing to recalibrate to a different, normal or normalcy, or whatever you want to call it. Or really recalibrate to a new environment, which has happened since 2022. Because if you think about it, on average, you have probably, call it, 300 to $400 billion of commercial real estate loans maturing. That's historically been about the average amount of loans maturing. Now you have closer to $1 trillion of loans maturing, which is obviously, call it, 2.5x that normal amount. And part of the reason, you have that is because of extend and pretend over the last 4 years, because as loans were maturing, you had banks, which make up about 50% of that wall of maturity. You look at the regional banks, national banks, community banks, they still house so much of these commercial real estate loans. They were, a lot of them were just extending out loans when the borrower couldn't pay them off versus, forcing a sell of the asset or foreclosing or whatever the case was. And so it continued to, they started doing these short term extensions. And that's what part of the reason why the wall started to grow is a lot of, banks were doing these extensions, and even non-bank lenders were, doing some, level of short term extensions with the hope and idea that, rates would get lower or the asset performance would improve to a level where they could go refinance based on the underlying performance of the asset. And, slowly, I think you have seen there's been so much fatigue over the last couple of years, and slowly you've seen two different things happen. One within on the Peachtree side, we've done a lot of refinances, where loans are maturing, but we've also started to buy a lot of debt from these regional banks that have these loans that are maturing where they just don't want to continue to extend. We're buying those loans. And over the last year, we bought probably close to, call it $1 billion of loans from banks where they could have, chosen to extended the loan, or they could have done something else with the loan, but they end up selling to us. And then we buy the loan. And then I would say in most cases, we end up extending the loan. We go through a loan restructure and extend it out. So there's been a lot of note sales that's been happening lately, because of this phenomena. But it is something that we saw during the GFC. We obviously saw, we're seeing it right now, and we saw it to, this wall, debt maturities. Again, it usually happens around these kind of, economic dislocations.
So you bring up the regional banks kind of shedding their, these loans from their balance sheets. I mean, do you think that long term they're going to no longer be the players that they historically were in, hotel and commercial real estate financing? Because obviously they were the bread and butter for so long. Like, is it going to be a situation where they're just, lending out money to private credit and then letting the private credit players kind of deal with the dirty work there? Or is it, once things normalize, they come back?
I mean, I'm a believer that the traditional banking model that I grew up knowing is broken. It's just
Mhm.
not coming back to the same levels. I don't think it's going to go away. But you're seeing the trend of banks today where they're very focused on deposits. They're focused
Mhm.
on, what is the real relationship we have with this client. So they're not in the mood of just renting, I would call it renting out their balance sheet, where someone's just coming to them for one loan, or one or two loans, and they're not going to utilize other services at the bank. So if they're going, they want to really have a real relationship with that borrower. And then in other cases, the challenge you're having is all the bank consolidation that's occurring, which, you had, 15,000 banks 40 years ago. Today, you have closer to 4,000 banks, and probably 5 years from now, you'll probably have less than 3,000 banks. And we're finding as, these banks merge, one plus one doesn't equal, two plus. It equals in most cases 1.5 or less when it comes to their lending limits or their ability to lend to sponsors exposure, limits. And so you're seeing a lot of exposure where they have too much exposure to certain, property types like hotels, or they have too much exposure to certain borrowers. And so that's forcing borrowers to find, alternative lenders, like a group like Peachtree, to come in and finance their projects. But I do think, because you brought this up, I think banks will continue to coexist with private credit, where they'll back leverage, private, lenders like Peachtree, or they'll partner. We even have certain banks that are partnering with us, where we're holding the B piece, we're doing loan participations, or even in, investing into some of these private credit firms. I think you'll see some of those activities because of the, regulatory pressure that a lot of these banks face. They can't really serve as a lender as we all knew from years ago, and it's easier for them to shift that and really transfer or shift that
Yeah.
risk to the private lenders or a group like us. And then they can, still retain, deposits, and, continue to provide banking services and other stuff.
It's interesting when you think of it in the context of the hotel industry, because it's not dissimilar from kind of the brand operator owner relationship. It's just there's a new intermediary phase in the financing realm that I think maybe the industry still needs to get a little used to, right?
That's right. Yeah. So it's, I mean, because you brought up the brand operator owner relationship. I mean, think about hotels like 40 years ago, Marriott, Hilton owned a bunch of assets, right? And they, they were, started shifting into managing assets, and then they got big into franchising. Now their models are going so asset light, where they're all focused more on the, franchising side, obviously. And, you can see it, it's a much more, I mean, it's much easier to scale in franchising versus, owning the actual real estate. It's obviously, you can see it between the public hotel REITs and the public hotel, the brands. I mean, you look at the public brands, how their stock prices have really skyrocketed over the last decade versus looking at the public hotel REITs, their stock prices
Well,
have gone a
the
different
fate,
direction.
I feel like the fate of REITs, hotel REITs, is an entire other podcast. There was so much to
Right.
unpack on that specific topic. So a lot of this discussion so far has kind of revolved around the kind of the traditional lending environment. Obviously, you guys have aptitude and expertise on kind of the alternative lending options like, CPACE, EB5, which although you guys are newer in the space, it's actually kind of funny and apropos that after we scheduled this recording session, I had a colleague who was just recently writing about EB5 and talking to someone, and they mentioned you guys specifically, how although you're a newer entrant, you're already one of the more like professional and kind of uh, well put together operators in that space. So where really are the opportunities in that kind of like non-traditional lending?
Yeah, so it's, when you think about non-traditional lending, and if you're defining it like CPACE, EB5, and so forth, I think it's, I think CPACE is huge in my opinion. Like that's probably something that, if you don't know about CPACE, you should learn about it, because, it's an area that's being utilized not only for new construction projects as a way to help, provide a source of capital for these projects that is relatively, cheap capital, but it's being utilized to help recapitalize, refinance, recently opened, hotel assets, really any type of commercial real estate property type. We're doing a lot of retroactive C-PACE loans. And so in a lot of cases, it can be utilized almost like rescue capital, where someone needs, capital in order to, maybe pay down their senior lender, because it's not secured by a first lien on the property. It's secured by a tax assessment on the property. And so the senior lender, which in a lot of cases could be a bank, is allowed to continue to hold their first position as long as they consent to the CPACE piece. They can utilize it as a source of liquidity to help give the owner of that asset, the owner of that hotel asset, or multifamily, whatever the asset is, to give them runway to stabilize that property. So that is an area that's, I think, everyone should learn about. I think EB5 has really changed over, the last, 20 years or whatever, the case is, because we have utilized it as a firm. We've utilized it on the equity side when developing hotel properties. We've utilized it on the credit side as a, loan feature, as a, a cheap mezz loan in certain cases, or senior loan. And then us as a EB5 lender today, what we're doing is we're actually providing loans, because obviously we're financing everything from construction to acquisition to refinances, as I mentioned. And usually we're doing these as first mortgage senior loans, where we're providing loans between 20 to 100 million plus in loan size. And so when we're providing development loans, like if someone's building, for instance, a new hotel property, we can step in and provide a, first mortgage loan where we can finance, typically 65 to 75% of the project costs. And, and we'll use, we'll have our, interest rate, and usually our interest rate will be, potentially a couple hundred basis points cheaper on a construction loan when we do it through our EB5 program. So if you're building in certain zip codes or certain, geographies that qualify for EB5, and where it qualifies the best is in these rural submarkets
Yeah.
across the US. And, in those cases, we can provide much cheaper capital as a senior loan to help you capitalize your project and provide, in a lot of cases, 75% financing or up to 75% financing of the total development cost. In some cases, even a little bit higher through EB5. So that's another area. And a third area that you didn't mention that is a little bit non-traditional too is the government lending programs. That's something that it hasn't been talked about as much. SBA, USDA, we're very close to getting a USDA, a non-bank USDA license, but USDA works very well with CPACE. So a lot of cases we'll provide a CPACE loan. There'll be, we can help put a USDA loan on that project, on a hotel property being built in certain areas that can help you finance new development hotel projects. But, SBA is another very viable program, which, they're, constantly, doing different things with the program to help improve it. But, we do own a non-bank SBA 7A lending business that we're super excited about, but it's really focused on financing smaller projects because you do have a limitation on that program where you can't lend above $5 million.
I just want to circle back really quick on the EB5 piece, just because I want to clarify something.
Sure.
And I could be totally off base on this, but the way I understand it is the EB5 requirements, they can often be kind of intimidating to as much as the dollars and cents can be appealing to a borrower. The requirements can seem kind of intimidating if you're somebody who doesn't have any expertise or experience in that space. But the way I understand it, like there are specific employment requirements, but that's handled on the lender side, right? Like that's something you guys would handle. That's not something the borrower would have to account for, correct?
That's exactly right. We have to, on our side, we have to, now we need the borrower to cooperate, and we'll have
Yeah.
certain language, in the loan
You obviously need the data and the information. Yeah.
That's right. Yeah, but it's very non-invasive to the borrower. It's very easy to provide. And because for every 10 jobs you create, you can technically raise $800,000 of
Yes.
$85. And that's the math behind it all. And so, we need to quantify how many jobs are going to be created, when we look at these development projects we're doing. And so if we're providing, a loan, and that's what makes it unique for us as a EB5 lender, because we have more tools, as a
Yeah.
firm, like as when we're providing, the CPACE loans. So we can do a CPACE loan and an EB5 first mortgage loan. In certain cases, we've done participations where we provide a whole senior loans, because again, to the borrower, they don't know the difference, but they're not creating enough jobs at the project level.
Yeah.
Because maybe the projects, because most construction projects, if it's a $20 million construction project, maybe they're going to create 200 jobs, and I'm just making up numbers here, and or assuming it's a $20 million loan. Well, if they're only creating 200 jobs, well, you only qualify in that example for $16 million. And so you're short $4 million. So on our side, we can bridge it by, doing, participation internally with non-EB5 dollars, or we can do a CPACE loan. So it becomes very seamless for the borrower. And that's why a lot of borrowers, once they realize they're not taking on the EB5 risk, we're taking that piece on at Peachtree. So we're backstopping it. It becomes very compelling for them to go with us versus some of the other, providers of EB5.
Yeah. And I think part of the point I was trying to get to is if you're not familiar at all with it, you see those numbers and you hear the headline like, 200 jobs equals 16 million. It doesn't mean if you borrow that 16 million, you have to have 200 people on property. Like that's an entirely different thing.
Yeah. Well, it is because it's an economic study that's looking at direct and
Yeah.
indirect
It's an
jobs.
entirely different
And
calculation. It's not a
exactly.
guarantee that it'll interfere with hotel operations, which I think if you're
That's right.
somebody who's first reading about this, that could be a little bit scary.
Yeah, because it's like if you think about direct jobs, like you have construction jobs that you create, those are for a period of time because the product's being built. And then you have jobs at the actual, at the site once it's operating, or at the hotel once it's operating. And that's only, if it's a $20 million loan, you probably have 20 to 30 full-time employees.
Yeah.
So you're way off on the math, but then you have the indirect calculation because you're looking at all the jobs that are being created because you're actually now bringing travelers and bringing people, consumers to that area that are going to create a need for, potentially for more grocery stores, restaurants, gas stations, and whatever the case is. So those are the indirect jobs that are being created as well.
So I want to ask you kind of a philosophical question. I mean, obviously, over the years, you guys have grown. I mean, Peachtree Group is a big, sophisticated operation. And I mean, you guys have moved beyond the kind of core competency of hotels to, any number of different verticals. So as kind of this multidisciplinary lender and investor, what do you think that added experience has kind of brought to your knowledge and perspective on the hotel industry?
Yeah, I think but we probably have a unique view just given the fact that, we're investing up and down the capital stack and we've been involved in so many different projects and so many different markets. So I do think it gives us a very good understanding of the business, of how the cycles can impact certain markets or certain hotels over the short periods, over the long periods. So I think if anything, it makes us a better lender. It makes us a better investor, when investing into the hotel space because hotels is it's a very tough asset class to invest into. It's probably one of the toughest property types when you think about commercial real estate in general. And even outside of commercial real estate, it is a very tough asset class, just given it is a operating business. It's very volatile. You do have direct impact to what's happening economically. You're always going to have a black swan event that no one sees because it wasn't on my bingo card that we were going to have a pandemic.
Yeah.
Back in 2019.
If you were expecting it, then your expertise would be in something else entirely.
Well, I probably wouldn't be on this exactly. I
Yeah.
wouldn't be on the podcast. I'd be doing something else. I'd probably be a mentalist or something. But so I didn't expect a lot. Everything that's happened had, again, it's just everything has a ripple, unfortunately, and those ripples impact the hotel space much more differently than when you look across a lot of the other property types. So it is, it's a great space. It's obviously a great area to invest into if you do it correctly. But it is, you've got to be very strategic and thoughtful. But I think it gives us, just given we've done so much and we understand the space very well. And we also understand all these different programs, like on the government lending side, or when you think about EB5 and CPACE and the SBA and USDA, we understand how to capitalize projects correctly on the credit side, lending side. I think it gives us a huge advantage when talking to borrowers, or even when we're the equity in projects and trying to capitalize our own projects. It gives us a much more competitive advantage over others.
Mm-hmm. So before we run out of time here, excuse me, really quickly, I mean, obviously, as we mentioned, you guys do more than lending. I'd love to hear kind of what's interesting and new in Peachtree broadly. And I know just this morning, as we said to record this, you announced something new with the Special Situations Fund you guys started up.
Yeah, so we're focused, obviously, as a firm. We're continuing to focus on doing a lot of direct lending through our credit team. So when you think about us doing acquisition loans, construction loans, and so forth, we'll continue to be very active there, as well as CPACE loans. But then on the equity side, when you think about us acquiring assets and developing assets, we're always looking for new hotels to acquire and develop. We have acquired a lot of stabilized hotels recently for a strategy on the DST side, where we aggregate 1031 money into these Delaware statutory trusts. And then, as you mentioned, we have our special situation strategy because we are believers, as we talked about earlier. This wall of debt maturities is causing a lot of challenges for owners of assets, and through our special situations vehicle, we're able to step in and help provide capital if someone needs capital because they need to bridge the gap between their existing senior debt and what a new lender will provide on financing. We can come in and provide like preferred equity. We can help come in and help potentially recapitalize projects on the equity side of transactions with our special situations vehicle. We can acquire assets and buy assets in a more structured type transaction. So we think there's going to be the need for, a lot of capital that's, probably more flexible than what we've traditionally seen, where groups are just selling assets outright. Because in a lot of cases, what we're seeing is, as someone's going through the process of selling an asset, they're not getting to a level that will compel them to go ahead and transact, but they're being forced to transact because of that wall of debt maturities, as we've talked about. And so, because we have this special situations vehicle, we can be a lot more strategic in how we work with different owners of hotel assets to allow them to still participate in the asset long term, where we're buying into the asset, or buying into a position, or buying with the idea of giving them some type of participation piece on the back end.
Greg, this has been a great conversation. I really appreciate you taking your time and sharing your insights. And I look forward to doing this again in 2027, when we can unpack why interest rates are magically 150 basis points lower, right?
That's right. That is, I'm sure it'll be totally, just based on the way everything has happened over the last couple of years, I'm sure it will be a totally different story in 2027. So,
Thank you so much.
all right, we'll talk soon.
The marquee gathering of the industry's data community is almost here. Join us August 5th through 7th in Nashville for the 18th annual Hotel Data Conference. With a unique mix of attendees, impactful networking, and practical best practices you can put to work immediately, HDC is where data turns into decisions. Visit hoteldataconference.com to view the 2026 lineup and secure your spot today.
This episode of the CoStar News Hotels Podcast was recorded on July 7th, 2026, and edited by me, Sean McCracken. Visit costar.com/hotel news for more coverage, and find all of our podcasts on Apple, Spotify, YouTube, or wherever you listen.